Do you know which book Warren Buffett read at 19? That changed his entire life. That book was The Intelligent Investor by Benjamin Graham. Not a get-rich-quick scheme, not a secret formula, but a lesson about you, about how you react when everyone's panicking, about why you sell at the worst time, about the emotional decisions that cost you everything. Part 1. The Intelligent Investor. The book that changed Warren Buffett's life. Graham taught something radical. Your biggest enemy in trading isn't the market. It's your own impulsive decisions. You see, most people think investing is about being smart, about timing, about inside information. But that's not true. Graham, the man who mentored Buffett, believes success comes from emotional discipline, from staying calm when others panic, from being boring while the crowd chases excitement. Because here's the truth about trading psychology. Every time you check your portfolio 10 times a day, you're not investing, you're reacting. Every time you buy because everyone else is buying, you're not thinking, you're following. Every time you sell in fear, you're not protecting wealth, you're destroying it. That's what the intelligent investor reveals, not through complex theories, but through simple truths that cut deep. Like how the market is designed to make you emotional, how your own psychology is wired against you, and most importantly, how to fix it. Try this. Before any trade, write down why, not the ticker, the emotion. Fear, greed, boredom. Watch the pattern emerge. Because once you understand what Graham understood, once you see the market not as a master, but as a servant, once you build the mental discipline of a true investor, everything changes. You stop chasing, start waiting, you stop reacting, start planning, you stop losing to yourself, start winning by doing less. That's the power hidden in this 75-year-old book. And in the next few minutes, you'll discover why the market's daily prices are just noise from a manic neighbor, how your fear and greed cost more than any bad stock pick, the simple mental framework that protects you from yourself, and one powerful exercise that transforms emotional traders into disciplined investors. Ready to meet the teacher who shaped the world's greatest investor? Let's begin with his most famous student, not a person, but a character. Someone you deal with every single day. His name is Mr. Market. Part 2. Mr. Market, the maniac you must ignore. Every morning, without fail, he shows up. Sometimes he's grinning, sometimes he's sweating. Sometimes he looks like he hasn't slept in days. He knocks, hard. He tells you today's the day, the big move, the perfect moment. Buy, it's going to the moon. No, sell, it's collapsing. Wait, buy again. It's back. His name is Mr. Market, and he's the most unreliable business partner you'll ever meet. But here's the catch. He never forces you to do anything. He just makes offers. Every day he quotes you a price for your stocks. Some days too high, other days far too low, and occasionally he gets it just right. But no matter the price, Mr. Market is emotional, wildly emotional. He doesn't value businesses. He reacts to headlines. He doesn't read balance sheets. He reads fear. And if you let him in, if you treat his daily knock as gospel, you'll start to feel like him, anxious, twitchy, compulsive. Because Mr. Market isn't rational, he's manic, and you are not supposed to be. That's what Benjamin Graham taught. You are not here to follow Mr. Market. You are here to take advantage of him. Because sometimes, when he's in one of his moods, he gets careless. He offers you a wonderful business at a laughably low price. Or he tries to buy something from you for way more than it's worth. That's when you act. Not because he said so, but because you've done your homework. You know what something is truly worth, and you've been waiting patiently for him to slip. That's what Graham meant when he said, the market is there to serve you, not to guide you. But here's the problem. We weren't raised that way. We were raised to chase validation, to follow trends, to panic when others panic and cheer when others cheer. We're social creatures, wired to mirror the herd, which means ignoring Mr. Market isn't natural. It takes effort, awareness, discipline, because he's so loud, so persistent, and he always sounds like he knows what he's doing. Let me tell you about Sarah, a real trader I knew. She started investing in 2019, smart woman, MBA, did her research, but she couldn't ignore Mr. Market. Every morning, she'd check prices. Every dip made her nervous. Every spike made her excited. When COVID hit and Mr. Market panicked, she sold everything. Just until things calmed down, she said. The market bounced back 70% without her. She bought back in at the top, afraid of missing more gains. Then inflation fears hit. Mr. Market panicked again. So did Sarah. In 2 years, she lost 40% of her capital, not because she picked bad stocks, but because she danced to Mr. Market's rhythm. Here's a technique. Set a market check schedule, once a week, same day, same time, no exceptions. Train yourself to ignore the daily noise. That's why this isn't just financial training, it's emotional training. To ignore Mr. Market is to resist your own impulses, your need for excitement, your fear of missing out, your craving for control. You have to unlearn how you've been taught to react and replace it with calm. And if you can do that, if you can watch him scream and stay quiet, you win. Because every time he panics and you don't, you grow stronger. Every time he overreacts and you hold still, you widen the gap. Until one day, you realize something strange. You're no longer tempted by him. You're entertained. You see his panic for what it is, a chance, an opening, a door left slightly ajar. Because the real investor doesn't chase, he waits. And Mr. Market always comes back. Every day. Knock knock, same drama, different price. But here's the warning. If you don't learn how to ignore him, if you react every time he barks, he'll wear you down, not with logic, but with noise. And slowly, your decisions will stop being your own. You won't be investing anymore. You'll be reacting, just like he does. And when that happens, you lose, even if you're technically winning. So remember this. You don't need to predict Mr. Market. You just need to recognize him. And then, step back. Let him dance. Let him yell. Let him twist in the wind. And when he finally offers you something beautiful, at a price only a fool would offer, you smile and say yes. Not because he told you to, but because you were ready. That's the power Graham gives you. And now that you've met the market, it's time to meet someone even more dangerous. You. Because the biggest threat to your financial future isn't out there. It's inside. Not Mr. Market, but Mr. You. In part 3, we'll go deeper into the fear, the greed, the twitchy little reflexes that cost you everything. You'll see why most people lose not because of bad investments, but because of untrained minds. Let's open that door and take a hard look in the mirror. Part 3. The real enemy isn't the market, it's you. You've seen him now, Mr. Market. You've watched his mood swing like a child on a sugar high. You've heard his voice, loud and anxious, knocking every morning with a new opinion, a new panic, a new thrill. But here's something you may not expect. He's not your biggest problem, because while Mr. Market is noisy, dramatic, and unstable, he doesn't force you to do anything. You can close the door on him. You can shake your head, turn off the screen, walk away. But what happens when the voice doesn't come from the outside? What happens when it's your voice? When it's your fear whispering in the night? What if I lose everything? What if I miss out? What if I made a mistake? What if I'm not enough? That's the real battle. Because the most dangerous trader isn't some stranger on Reddit or a hedge fund on Wall Street. It's the untrained version of you, the version that checks the portfolio 10 times a day. Not because there's a plan, but because you're afraid, bored, desperate for reassurance. The version that buys something not because it's undervalued, but because everyone else is buying it, and you're terrified of being left behind. The version that sells at the worst possible time, because the market dipped, your stomach turned, and you couldn't take the heat. Let me tell you about Michael, software engineer, 150 IQ, could solve complex problems in his sleep. Started trading in 2020 with $50,000. He had the perfect strategy, researched for months, back-tested everything. First month, up 15%. He felt invincible. Second month, down 8%. He started tweaking his system. Third month, down another 5%. He abandoned his strategy entirely. Started following trade alerts on Twitter, jumping from strategy to strategy, checking his phone during meetings, at dinner, in bed at 2 a.m. By month 6, he'd lost $30,000. Not because his original strategy was bad, it was actually solid, but because he couldn't handle the emotions, the fear during drawdowns, the greed during wins, the constant need to do something. His 150 IQ meant nothing when his emotions took the wheel. Trading psychology exercise. Keep a decision journal. Before every trade, write down 3 things. First, what you're doing. Second, why you're doing it. Third, how you're feeling. Review monthly. The patterns will shock you. It's not about intelligence. It's about emotional stability. You can have the best investment thesis in the world, but if your hands shake every time the market moves, it won't matter. You'll sabotage yourself before your strategy has a chance to work. That's what Graham was trying to tell us, that the hardest part of investing isn't finding good opportunities. It's holding on to them. It's resisting the urge to jump, to chase, to flinch. And most of all, it's becoming the kind of person who can sit still in chaos. But how do you do that? You start by seeing your own patterns. Think back. Have you ever made a decision just to feel in control? Sold something just to stop the bleeding? Bought something just to fill the silence? You're not alone. We all do it. Remember 1929? The Great Crash? Most investors who held through it recovered within 10 years, but 90% sold at the bottom. Fear beat math. Because investing at its core reveals our psychology. It exposes our hopes, our wounds, our unfinished stories. That's why your portfolio can feel like a diary you didn't mean to write. Each trade, a sentence. Each panic, a confession. But here's the gift hidden inside that discomfort. If you're willing to look, really look, you'll find something beautiful. You'll find the parts of you that need healing. You'll see how much of your investing behavior comes not from logic, but from emotion, from childhood, from identity, from fear of failure, or fear of success. And you'll begin to shift. You'll start asking better questions. Not will this stock go up tomorrow, but why do I need it to go up? What am I trying to prove? What would happen if I didn't act right now? Meditation technique. Before opening your trading app, take 5 deep breaths. Ask yourself, am I acting from fear or from strategy? This simple pause can save thousands. These are the questions that slow your breath, that bring you back to yourself, that remind you you are not your portfolio, you are not your gains, you are not your losses, you are the one who chooses. And the moment you remember that, you win. Because now, you can start to build something solid. You can become the kind of investor who doesn't flinch. The kind who knows that panic is temporary, but regret lasts forever. And the kind who understands this truth. The most dangerous moment in investing is when you feel the most certain. Because certainty breeds carelessness. It makes you skip the basics, ignore the warning signs, go all in when you should be stepping back. That's why Graham taught us to build a system, a simple, rational structure, so that when emotions run high, and they will, you don't have to guess. You follow the plan, like a pilot in a storm, flying on instruments. No drama, no improvisation, just trust. Because here's the final twist. The goal of investing isn't to avoid emotion. It's to build a strategy so clear, so grounded, so boringly rational, that emotion has nowhere to hide. And the first brick in that strategy is knowing who you are. Not in theory, in practice. Are you calm under pressure or reactive? Are you playing the long game or chasing quick wins? Are you investing or are you searching for something deeper? Validation, escape, redemption, no judgment, just awareness. Because once you know who you are, you can decide who you want to become. And that, more than any ticker symbol or stock tip, is the foundation of intelligence in investing. But now that we've looked inward, it's time to look outward again. Not at the chaos of Mr. Market, but at the kind of investor you could become if you stopped trying to beat the system and started choosing the right path for you. In Part 4, we'll explore the 2 roads ahead. The defensive investor, the enterprising investor. One focused on peace of mind, the other on higher returns with higher responsibility. No path is better, but one of them is yours. Let's find it. Part 4, which investor are you, defensive or enterprising? By now you've seen the battlefield. You've watched Mr. Market rage. You've recognized the voice inside you that whispers doubt. You've taken a breath and stayed still. That's a victory. But now comes the moment of choosing. Because intelligent investing isn't one size fits all. There isn't a single path everyone should walk. There are two clear, honest paths, and neither one is better. They're just different. The first is calm, steady, deliberate. It doesn't ask much from you, just patience, discipline, and the willingness to stay the course even when everyone else is jumping ship. This is the path of the defensive investor. The second is more active, more demanding, more alive with possibility and responsibility. It asks you to think harder, study deeper, swim against the current, and own your decisions when things go wrong. This is the path of the enterprising investor. So, let me ask you something. Right now, not who you want to be, but who you are. Which one sounds like home? Don't rush. Don't choose based on pride. This isn't a question of ego. It's a question of energy, of temperament, of what kind of relationship you want to have with your money, your time, and your peace. Let's start with the defensive path. It's often misunderstood. People hear defensive and think weak, passive, scared. But it's the opposite. It's a quiet kind of strength. It's the kind of strength that knows what matters and what doesn't. The defensive investor doesn't try to predict the market, doesn't chase trends, doesn't gamble. They know their goal isn't to beat anyone. It's to protect, to grow steadily, to sleep at night. And they do that through simplicity. They diversify. They rebalance. They stick to quality companies and low-cost index funds. They automate what they can, so their emotions don't get a vote. And most of all, they have no desire to impress anyone, because they know slow wealth is still wealth. Quick story, Janet Teacher started index investing in 1995. Her trader brother Tom chased hot stocks. 25 years later, Janet retired with 1.2 SARs. Tom's still working, still stressed. Now, maybe that sounds like you. Maybe you're not looking to win. You just want to be free, stable, unshaken. Then let that be enough. You don't need to chase more. But maybe you feel different. Maybe your mind wants to analyze. You love learning, digging, understanding what others miss. You want to study balance sheets, look under the hood of businesses, spot the hidden value others overlook. Then maybe you're meant for the other path, the enterprising investor's road. This isn't the easy route. It's not passive income. It's not set it and forget it. It's work that demands time, energy, focus. But for some people, it's energizing. They don't mind the extra effort because they enjoy the game. They take pride in thinking differently. They find joy in doing the research others avoid. And when they find a gem hiding in plain sight, they feel something that can't be faked. Conviction. Now, before you pick a side, let me be clear. This is not a personality test. It's not fixed. You can start one way and shift later. You can be defensive in one season of life and enterprising in another. It's not about labels. It's about alignment. Are you investing in a way that fits the truth of who you are? Or are you trying to copy someone else's plan, hoping it'll give you the same results? That's where most people go wrong. They see someone online making millions trading options or flipping IPOs and think, maybe I should do that too. But what they don't see is the sleepless nights, the losses, the self-doubt, the stress. Because if you're not built for it, if it drains you more than it fuels you, it doesn't matter how high the upside is. The real risk isn't losing money, it's losing yourself in the process. So ask again, not what sounds impressive, but what feels peaceful. Which path lets you breathe deeper? Which path makes sense for your nature? If it's the defensive path, embrace it fully, commit to simplicity. Let compounding do the heavy lifting while you live your life. If it's the enterprising path, embrace that too. But don't treat it like a game, treat it like a craft. Study, practice, journal, reflect. Because your results won't come from instincts, they'll come from process. And now that you've chosen, or at least glimpsed your path, we can go deeper. Because whichever way you walk, there's one principle that holds everything together. A single idea that protects you from ruin, from regret, from the randomness of life. It's not glamorous, it won't go viral, but it may be the most powerful concept in all of investing. It's called the margin of safety. And in part 5, we'll explore why Graham believed it wasn't just a technique, but a philosophy of living. Let's turn the corner and build a shield that never rusts. Part 5, Margin of Safety. The shield that never rusts. It's a quiet phrase, easy to overlook. 2 words, margin of safety. But inside those words is a kind of magic. A shield, a lifeline, a philosophy that protects you when everything else falls apart. You've chosen your path now, defensive or enterprising. And whichever road you're on, there's one truth that never changes. You will be wrong sometimes. You'll misread a business, misjudge a price, get the timing off, miss something crucial. That's not a flaw, that's human. Even Graham, with all his brilliance, made mistakes. So he built in a buffer, a space between what something is worth and what you're willing to pay. That space is your protection, your breathing room, your margin of safety. Imagine you're building a bridge. The heaviest truck that will ever drive across weighs 10 tons. So, what do? You build the bridge to hold 30. Why? Because reality is messy. There's wind, stress, surprise. Maybe one day 2 trucks go across. Maybe one has extra weight you didn't account for. Maybe the materials age faster than expected. You don't build a bridge for perfect weather. You build for storms. You don't build for the perfect scenario. You build for the real world. And in the real world, things go wrong. Margin of safety is how you stay standing when they do. It's how you invest not with blind optimism, but with grounded wisdom. You never bet the farm. You never assume everything will go right. You leave room. Room for error. Room for surprise. Room for life to do what life does. Let me tell you about David and Anna. Both found a retail chain trading at 60% of calculated value. David went all in, even borrowed to buy more. It's a steal, he said. Anna bought too, but only with money she could lose, at an even deeper discount. Kept cash reserves. 2008 crashed everything. The company was undervalued. They were both right, but David had no margin. When credit froze and the company couldn't refinance, bankruptcy. He lost everything. Anna, down 50% but survived, held on, even bought more at the bottom. 5 years later, she'd tripled her money. Same opportunity, different approach. One built a bridge for perfect weather, the other built for storms. Graham's exact formula. If a stock is worth $100, don't pay more than 60 Scousers. That's a 33% margin of safety. In bad markets, demand 50%. And here's the truth most people miss. Margin of safety isn't just about money. It's about how you live. Do you stretch every dollar to the edge? Do you plan your schedule so tightly that one delay ruins the day? Do you push your risk, your leverage, your energy to the max? Or do you leave space? Not because you're scared, but because you're smart. Margin is not fear. It's wisdom. It says, I know I don't know everything. It says, I'm human. I miss things. It says, I'd rather be safe and alive than smart and wiped out. And in investing, it looks like this. If you think a company is worth $100 per share, you don't buy it at 98. You don't buy it at 90s. You wait. You buy at 70, maybe 60. Why? Because your estimate might be wrong, or the business might change, or the market might panic. You give yourself room. That way, even if you're partly wrong, you're still protected. That's what keeps you in the game. That's what lets you sleep. But most people don't want that. They want the rush. They want the thrill of buying early, selling high. They want to feel like a genius until the wind changes, until the earnings disappoint, until the price drops 40% overnight and they have no margin, no room, no out. Then they learn, sometimes too late, but not you. You're learning now, you're building now. You're laying down the bricks of a portfolio that doesn't crack every time the world shakes. That's what margin of safety gives you. It doesn't guarantee profit, but it does offer survival, and survival is the first rule, because if you stay in the game long enough, wealth becomes inevitable. You don't need to hit home runs, just don't strike out. And Graham's way is how you avoid the strikeouts. But here's where it gets real. Margin of safety isn't sexy. It's not exciting. It's not what influencers post about. It's boring. It's waiting for the right price. It's saying no more than yes. It's sitting with cash while others chase dopamine. But boring is beautiful, because when everyone else is bleeding from their high-stakes bets, you're still standing, still holding, still thinking clearly. That's what margin gives you, a clear head, a calm heart, a longer runway. It's not just how you survive bad markets, it's how you deserve the good ones. And now that you understand this shield, we can talk about how to use it, because the next question is simple, but dangerous. How do you decide what something is really worth? How do you find value, real value, beneath the noise? That's what we'll explore in Part 6, where price meets value, where emotion meets logic, where shopping for stocks starts to feel like shopping at a grocery store, because sometimes the best investing lessons come from a discount aisle. Let's go there next. Part 6, Price versus Value, How to Shop for Stocks, like you shop for groceries. Picture this. You walk into your favorite grocery store. There's a row of apples on the shelf, bright, shiny, perfectly stacked. One apple costs $10. You blink. $10? You move to the next bin. Same apples, same brand, same weight. But these are $2. You smile, pick up 3, and head to checkout. No drama, no debate. You just made a smart decision, because deep down, you know what something should cost. You know the difference between fair and foolish. And that's the mindset Benjamin Graham wanted you to carry into the stock market. Price is what you pay. Value is what you get. That line, coined by Warren Buffett, echoing Graham, is one of the most misunderstood truths in all of investing. Because in the market, the apples don't come with clear labels. Sometimes the $2 apple is bruised. Sometimes the $10 apple is pure hype. Sometimes both are overpriced, and nobody notices. So, what do most people do? They follow the crowd. They buy whatever's moving. They confuse movement with meaning. But price by itself tells you nothing. Just because something is expensive doesn't mean it's good. Just because something is cheap doesn't mean it's a bargain. The real question is, what is it worth? That's where value lives. Not in the ticker, not in the price change, not in the headlines, but in the business underneath the stock. Let me tell you about Rachel, height of the meme stock mania. Her friends were making money on GameStop, AMC, anything with momentum. You're missing out, they said. It's going to 1,000. Rachel almost caved. The price was flying. The excitement was real. But then she remembered Graham's grocery store wisdom. She asked, what is GameStop actually worth as a business? Declining sales, no clear turnaround plan, burning cash. The stock was priced like a Ferrari, but running like a broken bicycle. She passed. Her friends made quick money, then lost it all when reality returned. Meanwhile, Rachel found a boring insurance company, steady profits, trading at half its book value. No one talking about it. She bought, waited, doubled her money in 18 months. Not exciting, but real. Modern example, in 2022, people paid $300 for Peloton, home fitness. Same year, Berkshire Hathaway owns 60-plus profitable businesses, traded at similar P/E ratio. Which is the better apple? That's what Graham taught us to look for. He said, every stock is not just a symbol on a screen. It's partial ownership in a real company, with real customers, real income, real problems, real potential. So, when you look at a stock, you're not asking, what will other people pay for this next week? You're asking, what is this business really worth, and is the price I'm paying fair? That's how value investors think. They shop like grocery buyers, not auction bidders. They don't get caught in hype. They ask boring questions, the kind that matter. What does this company sell? How consistent is its profit? How much debt does it carry? Is it growing sustainably or recklessly? And most of all, is this price justified? It takes work. It takes patience. It takes saying no 90 times before saying yes once. But here's the reward. When you buy something below its true value, you get two benefits. First, you lower your risk. Even if things go a little wrong, you're still protected. Second, you increase your upside. Because when the market wakes up and sees the true value, you win. That's not luck. That's preparation. But you can't do this if you're focused only on price, because price changes every second. Value changes slowly, like a tree growing. And value doesn't scream, it whispers, which means you have to learn to listen, to read financial statements, to study patterns, to ignore the noise and trust your analysis. It's not thrilling, it's not quick, but it's the difference between gambling and investing. Let me give you an example. Imagine two companies. Company A is hot. Everyone's talking about it. It just IPO'd. Price doubled in 3 days. You look deeper. No profits, huge debt, unclear product, but it's trending. Company B, quiet, old brand, solid earnings, consistent dividends, stock price flat for months. Which one do you buy? Most people pick A because it's exciting, because it feels like a rocket ship they're afraid to miss. But the intelligent investor, they choose B because they're not chasing movement. They're hunting value, and value takes time to be recognized. Graham said it best. In the short run, the market is a voting machine. In the long run, it is a weighing machine. Short term, people vote with fear, hype, emotion. Long term, reality sets in. And if you buy based on value, reality eventually rewards you. Not always fast, not always flashy, but steadily, deeply, unshakably. So next time you're tempted to chase a rising stock, ask yourself, if this were a bag of apples, would I still be buying it? That question might save your future. And now that you understand price and value, it's time to face the final illusion. Because there's one silent force that erodes value without you even noticing. It doesn't crash, it doesn't panic, it just eats away, slow, quiet, devastating. Its name is inflation. And in part 7, we'll shine a light on this hidden enemy. We'll explore why even smart investors lose money, not because of bad decisions, but because of invisible decay. Let's step into that shadow and learn how to fight what we can't see. Part 7. Inflation. The hidden psychology of losing. Slowly. There's a thief in your house, right now. You can't see him, can't hear him. But every night he steals a little more. Not your TV, not your jewelry, your future. His name is inflation. And here's why he's so dangerous. He doesn't make you panic. He makes you comfortable. Think about it. When the market crashes 30%, you feel it. Your stomach turns. You want to act, sell, buy something. But when inflation steals 3% a year, nothing. You feel nothing. Your bank account shows the same number. Your salary feels stable. Everything seems fine. Until one day you realize that $100,000 you saved, it only buys what $70,000 bought 10 years ago. That retirement fund, it won't last as long as you thought. That dream, it just got 30% more expensive. Think of inflation as a silent river, slowly eroding the foundation of your wealth. You don't see it working, but one day the house collapses. And here's where psychology gets cruel. Inflation doesn't just steal money, it hijacks your behavior. When people sense prices rising, what do? They panic buy. Better get it now before it costs more. They chase returns. I need 15% gains to beat inflation. They abandon patience. I can't afford to wait. In other words, inflation turns intelligent investors into emotional gamblers. I watched this happen to my Uncle Robert. Inflation hit 8%. He'd been a careful investor for 20 years. Index funds, bonds, steady growth. But when he saw his purchasing power shrinking, he panicked. Started trading crypto, buying gold mining stocks, chasing anything that promised to beat inflation. In 1 year of trying to outrun inflation, he lost more money than inflation had taken in a decade. The thief made him rob himself. But Graham saw through this. He knew inflation was like a slow leak in your boat. Ignore it and you sink. Obsess over it and you make reckless moves. So, what's the answer? First, recognize the mind game. When you hear inflation is 6%, your brain whispers, do something, anything. That's the trap. Because the worst investment decisions come from inflation fear. Buying overpriced assets because they'll go up with inflation. Dumping good stocks to chase commodities. Taking wild risks to stay ahead. But here's what actually works. Accept inflation. Don't chase it. Graham's approach was brilliant. Own some stocks. Companies can raise prices with inflation. Own some bonds for stability when stocks crash. Keep some cash for opportunities when others panic. Action step. Allocate 20 to 30% of your portfolio to quality dividend stocks. Companies like Coca-Cola and Johnson & Johnson have raised prices for decades. And most importantly, don't let inflation news change your temperament. Because inflation is like traffic. It's always there. Sometimes worse, sometimes better. You can't eliminate it, but you can build a portfolio that handles it without losing your mind, without abandoning discipline, without becoming the very emotional investor Graham warned against. Remember, the market makes noise every day, but inflation whispers for decades, and those whispers, you're falling behind. You need more risk. You can't afford patience. They're lying. The only thing you can't afford is letting inflation turn you into someone you're not, an emotional trader chasing shadows, instead of an intelligent investor building wealth, slowly, surely, sanely, even while the silent thief works in the darkness. Because in the end, it's not about beating inflation perfectly. It's about not letting inflation beat you psychologically, and that's a game you can win. But now we face an even louder enemy, not silent like inflation, but deafening. The roar of the crowd, the pull of the trend, the fear of missing out. In Part 8, we'll explore why hype might be the most expensive emotion you'll ever feel, and how to stay grounded when everyone else is losing their minds. Let's step into the noise. Part 8, Hype, FOMO, and the cost of chasing the crowd. Let's start with a feeling, that tight pull in your chest, the itch in your fingers, the voice in your head that whispers, if I don't get in now, I'll miss it. It's not logic. It's not analysis. It's urgency. That's the feeling of FOMO, fear of missing out. It's ancient. Long before stock markets, we felt it in the village square, everyone running to something, and you standing still, wondering if you're the only one being left behind. It's deeply human, but it's also deeply dangerous, because in investing, the thing everyone's running toward is often a cliff. That's the psychology of hype, and it's why some of the most painful losses happen after the biggest rush. Let's tell a story. It's the year 2000. .com stocks are soaring. Companies with no profits but a website are being valued at billions. Taxi drivers are giving stock tips. Teenagers are day trading. News anchors are saying, "This time, it's different." You feel it, the excitement, the heat. You're watching others get rich, quickly, publicly, loudly, and you think, if I just put in now. But then, the crash. NASDAQ drops nearly 80%. Fortunes evaporate. People lose everything, not just money, but time, trust, confidence. That's what hype does. It promises freedom and delivers regret. Now, look at Bitcoin 2021. From 10K to 69K in 1 year, Reddit screaming 100K incoming, then down to 16K. Same story, different costume. Now fast forward to 2021, different year, same story. This time it's GameStop, AMC, Dogecoin, diamond hands, they shout. To the moon, stick it to Wall Street. My neighbor Kevin, a plumber, never bought a stock in his life, but suddenly he's on Reddit at midnight, buying GameStop at $300. It's a movement, he says, you don't understand. 3 weeks later, it's at $40. Kevin's down 85%. The movement moved on, without him. Because when you invest out of fear, not of loss, but of being left out, you stop thinking clearly. You ignore fundamentals. You skip the homework. You tell yourself stories like, it's the future. Everyone's getting in. I'll just ride the wave for a bit. I'll sell before it drops. But here's the truth. Nobody rings a bell at the top. You don't know when the music stops until it already has. And you're left standing with overpriced assets, broken conviction, and a bitter taste in your mouth. Graham warned us. He said, the intelligent investor is a realist who sells to optimists and buys from pessimists. In other words, when everyone's celebrating, you step back. And when everyone's panicking, you lean in. That's not contrarian for the sake of being different. It's discipline. It's recognizing that hype clouds judgment, that markets, like people, swing from euphoria to despair. And your job isn't to follow their mood. It's to stay rooted. So, what do you do when something starts to feel like the next big thing? You pause, you breathe, and you ask, would I want to own this company if the stock market shut down for 10 years? If the answer is no, walk away. Because price moves are not the same as value, and popularity is not the same as strength. The intelligent investor isn't afraid to miss out. They're afraid to give in, because giving in feels good in the moment, but costs you dearly later. It's the same reason people jump into crypto at the peak, or buy IPOs on day one, or pile into meme stocks because this time, it's different. But let me say this clearly. This time is never different. People are people. Fear is fear. Greed is greed. And history always rhymes. Which means the best investors don't chase. They observe. They see the heat. They acknowledge the buzz. They smile politely and wait. Because hype burns fast, but value lasts. And when the flames die down, when the trend cools, when the crowd disappears, that's when opportunity often quietly appears. In the ashes, unhyped, unsexy, underpriced, and ready to grow without noise. The crowd is usually wrong. Your edge is discipline, not brilliance. That's where the intelligent investor lives. Not in the excitement, in the clarity, not in the crowd, in the calm. So next time you feel that itch, that urge to jump in because everyone else is doing it, ask yourself, if no one knew I made this investment, would I still want it? Because intelligent investing isn't public, it's private. It's between you and your principles. And that brings us to the final step. You've seen the emotions, you've seen the traps, you've seen the structures. Now, it's time to bring it all together. To understand how value investing actually works in practice, how you can apply all of this and build something stable, powerful, and deeply yours. In Part 9, we'll get concrete. We'll walk through how to pick a stock the Graham way. No hype, no magic formulas, just clarity. Because once you see the process, you'll never look at the market the same way again. Let's go there next. Part 9. How to pick stocks without losing your mind. Let's make this simple, dead simple. Because Graham's method isn't about being a genius. It's about being sane. Here's what most people do. They hear a hot tip. They see a chart spike. They feel FOMO. And they buy. No plan, no process, just emotion. Then they wonder why they lose. But you're different now. You've learned the psychology. Now let's add the process. Graham's checklist, simplified for sanity. First question. Do I understand this business? Can you explain what they sell in one sentence? If not, walk away. You can't value what you don't understand. And you can't stay calm about what you don't grasp. Second, profitable for 5+ years. Not promises, not next year. Real profits. Track record. Because profitable companies survive panics. Third, debt less than 50% of equity. High debt amplifies fear. Low debt means breathing room. Fourth, price reasonable. Graham's quick check. Is the PE ratio under 15? That means you pay less than 15 years of earnings. Is the PB ratio under 1? 5. That means you pay less than 1. Affects the company's assets. Simple translation. If a company earns $1 per share, don't pay more than $15. That's PE of 15. Fifth, could you hold for 5 years? Not will it pop tomorrow? But is this a business I'd want to own? That's it. 5 questions. Not to find perfection, but to avoid disasters. Real example with numbers. Lisa found Costco in 2019. Understood it? Yes. Bulk retail. Profitable? Yes. 20 years straight. Low debt? Yes. Under 30%. Price fair? No. PE was 35. Too high. She waited. 2022. PE dropped to 25. Still high. Late 2022, PE hit 22. She bought at $480. Today, $580. Up 20% plus dividends. Not because she was brilliant, because she was patient. Action step. Write these 5 questions on a card. Check every stock against them. No exceptions. The checklist forces you to slow down, to think before you click, to have reasons beyond everyone's buying. Because the checklist isn't really about stocks. It's about you. It's your defense against impulse. Your protection from FOMO. Your Graham-given superpower. And when you find a company that passes all 5 questions, you still wait for your price, with your margin of safety, like a fisher waiting for the tide. Not because you have to, but because you can. Because you're not desperate anymore. You're not chasing anymore. You're choosing. With clarity, with patience, with Graham's wisdom, one decision at a time. And now you have the tools, the psychology, the framework, the discipline. Which brings us to the end. The final piece that holds everything together. In part 10, we'll create something most investors never do. Your personal investment contract. Your North Star when the storms come. Let's write it together. We've reached the end, but really, it's your beginning. You've seen the traps. Mr. Market's mood swings, your own emotional reactions, the inflation mind games, the FOMO that kills wealth. You've learned the defenses, value over price, patience over panic, discipline over drama, process over prediction. Now comes the most important part, your personal contract, not with a broker, with yourself, because all the knowledge in the world won't save you. When GameStop is soaring and your friends are getting rich, when crypto is crashing and fear fills your chest, when inflation headlines scream and you want to do something, that's when you need this, your written promise, your psychological anchor. Right now, yes, right now, pause this audio. Get a pen and paper. Write what I'm about to say, then come back. I'll wait. Ready? Here's your contract. I am an intelligent investor. I buy businesses, not ticker symbols. I act on value, not on headlines. I embrace patience, especially when it's hard. I check my portfolio monthly, not daily. I celebrate boring returns over dramatic swings. I ignore Mr. Market's opinions. I remember, the crowd is usually wrong. My goal is wealth, not excitement. My edge is discipline, not brilliance. Now, add one personal line. Something just for you. Maybe, I invest for my family's future, not my ego. Or, I choose peace over performance. Or, I am building wealth, not chasing thrills. Make it yours. That's your contract. Print it, frame it, read it, every Sunday night, before every trade, whenever you feel the itch. Because investing isn't a skill you master once. It's a practice you maintain, like fitness, like meditation. Every day the market tests you. Every day your emotions rise. Every day you choose, react or reflect, follow or think, Graham or gambling. The contract reminds you who you've decided to be, not when it's easy, but when it's hard, when everyone else is losing their minds. And that's the final gift of the intelligent investor. Not a system for beating the market, but a way of being that beats yourself. Your fearful self, your greedy self, your impatient self. Because in the end, the market isn't your enemy. Your psychology isn't your enemy. They're just forces to understand and channel. With Graham as your guide, with discipline as your edge, with patience as your power, you're ready now, not to trade, but to invest, not to react, but to build. Welcome to the intelligent investor's path. May you walk it with wisdom, and may your wealth grow as quietly as your confidence. The market is waiting, but now, so are you. And if you want to dive deeper into Graham's timeless wisdom, read The Intelligent Investor. Because what you've heard today, it's just the beginning. Action today. Write your contract, read it tonight. Start tomorrow as an intelligent investor. Bonus, quick recap. The 10 Commandments of Intelligent Investing. Before you go, let's crystallize everything into 10 simple rules. First, Mr. Market serves you. He doesn't guide you. Second, your emotions are the enemy, not the market. Third, know yourself, defensive or enterprising. Fourth, margin of safety. Always leave room for error. Fifth, price is not value. Shop like you're buying groceries. Sixth, inflation is psychological. Don't let it change your temperament. Seventh, FOMO is expensive. Missing out costs less than giving in. Eighth, use a checklist. Process beats instinct. Ninth, think like an owner, not a trader. 10th, write your contract and read it when times get tough. Your portfolio is a diary you didn't mean to write. Make sure it tells a story of discipline, not drama. These aren't just rules. They're your protection, your wisdom, your edge. Use them and watch your wealth grow, slowly, surely, sanely. Just like Graham taught, just like Buffett proved, just like you can too. Thank you for listening. Now go forth and invest intelligently. Start today. Start small. Start smart.